Dheeraj Sachdev, Senior VP and Fund Manager, HSBC Asset Management, joins us on the show right now. Dheeraj, it's good to have you on the show. You have quite a few interesting stocks in your portfolio under management. Why do you like some of the lesser known names like Arane Holding or Balmer Lorry, or even for that matter Majestic Auto, some of the smaller mid-cap names?
Well, I can't discuss about stock specifics, but in general, our view is that mid-caps tend to perform in when the recovery in economic cycle happens, and I believe there's a very strong case where the mid-caps have a tendency of reversion to the mean. I think last 2-3 years the markets have been focusing and confined especially to the larger cap segment, and as a result of which the gap between the valuations of large caps and mid-caps have got distorted. So we believe that as most of the mid-cap and small-cap companies are quoting at much attractive valuations, of course one has to be very selective with regard to that, but in general we are inclined towards mid-caps as a segment.
Dheeraj, if I look at the P multiple for the Sensex and the P multiple for the BSE mid-cap index, the P multiple for the Sensex is 14 times, the P multiple for the BSE mid-cap index is 13 times. So the difference is not there.
Broadly, you're correct, but we still believe that there is enough opportunity because the universe in the mid and small cap category, Nikunj, is pretty large. There are about 2,000, 3,000 odd companies to choose. So obviously stock selection makes a difference. And even within that, there is a distortion where some of the mid-cap companies in the FMCG and pharmaceutical space may be expensive relatively to the other sectors. Besides, there are companies in whether in agrochemicals or auto ancillary or select real estate names or valuations in the banking space may be much attractive to the averages which are indicated by the BSE mid-cap per se.
Given the kind of policy news flow we've got from center when it comes to oil and gas sector, are you a buyer there now?
We are positive on oil and gas given the fact that policy decision has been pretty positive. I think the direct cash transfer as well as allowing the oil marketing companies to tinker with diesel price raising, I think it's a step in the right direction and will have longer term positive implication on the sector per se.
What are the themes that you are most bullish about at this point in time, ahead of the budget?
We continue to like interest sensitives. We believe that the time has come where the RBI may have some headroom for cutting the rate cycle over the next 12 months or so. I remember the fact that if I have to go back all the way till December 2011, we virtually had 13 rate hikes equaling to about 375 basis point, and much of the calendar year 2012 was a year of pause as far as interest rate is concerned, policy is concerned. So now with the fact that we believe that inflation may be probably lower by 200 to 300 basis point from the peak of 2011, this will give RBI some room for rate cutting cycle to begin. Our estimate is anywhere between 75 to 100 basis point for the year. Now the question is whether it will happen in the Jan end policy or subsequently is debated, but the fact that the time has come where the rate cutting cycle should begin.
Dheeraj, you've not liked real estate stocks in the past. Are you still avoiding them?
Real estate stock, again, one has to be very selective. We are largely negative on some of the companies which have very high debt in the balance sheet, leverage. They have bought land in 2007, 2008 at exorbitant prices, too much of leverage, etc. So we have been avoiding it for the last couple of years. But one has to be very selective because geographies like Pune, Bangalore, or some of the companies with low leverage in the balance sheet do offer investment opportunities. So one can't shun that sector completely because there is still potential demand where the companies, if they manage the cash flows well, they will deliver. So we are very selective on the sector.
Is it too early to buy engineering, construction, builders? There's a hope that economy will revive, but at a time when builders are pulling out of road contracts, HAI is confused on how to allocate new contracts. I guess it's a difficult time for construction stocks.
You're right, Nikunj. I think the investment cycle is yet to pick up, and we may actually see disappointments in earnings in the construction, power equipment businesses, etc. over the next 2 to 3 quarters at least before it starts picking up. But the fact is that yes, near-term visibility is poor. But again, in the infrastructure pack, one has to divide businesses across 2 or 3 segments. There are infra financiers, there are infra creators, and there are infra owners. So the BOT asset owners like road projects who have fairly mature road assets may be worth looking at. But the fact is that a lot of others have higher working capital cycles. They've borrowed at 13 to 14% rate of interest, so they have pinching on the interest costs in their P&L statements. So we would prefer infra financiers and some of the asset owners which have matured asset which has started yielding them results or cash flows compared to the segment as a whole. But you're right, I think it is too early to take a call. Again, one has to be very selective in the sector, though it has long-term potential, but one has to live with 2 to 3 quarters of disappointments at least.
For this year, what are your key overweight and underweight positions? On every uptick, what are you proposing that you want to sell? On every decline, what are you planning to buy?
Nikunj, our investment process is largely driven by a price to book and ROE model, and which means that we are value focused. And at this point of time, we are inclined towards autos, banks, some of the cement companies, selective engineering companies, and underweight on maybe global cyclicals to an extent, FMCG and pharma, largely because of the disparity in valuations between these 2 segments. So to answer your question, FMCG and pharma are the underweighting position as of now.